let's try and shape the market, not in a predictive sense, but in an analytical way. If you look at the total volume of lending from alternative sources of finance, and it's very hard to get a handle on these numbers, but let's have a go. In the UK, there is a De Montfort University Bank of England study that's published on a half-yearly basis. And one of the significant trends that's been highlighted by this study, and it's been going now for 17 years, is the emergence of the alternative debt fund market. The size of that market relative to the banking market as a whole in the UK is tiny. If you look at the alternative debt funds, they represent somewhere between 5 and 9% of the total lending. If you add on the insurance companies who have been at it for a very long time, you get up to 19% of the entire banking market in the UK is non-banking sourced money. And that's over the last 4, maybe 5 years. That trend, if you look at INREV now and what they show as data for the growth of the alternative debt funds, is probably consistent. So if you look at the total volume, UK and continental Europe together, of traditional debt finance from banks versus non-traditional debt finance, it's likely still to be in the range somewhere between 80 and 85% banking, 15 to 20% non-banking. Now those are very rough numbers connected by a number of different dots, but it is probably fair to say that if the maximum you could anticipate across Europe is 20% from alternative debt funds, and not all of that money will go into development finance, the conclusion would be the amount of development finance coming out of the alternative debt fund market is by definition relatively small. And if I had to guess, it's probably between 5 and 10% of the entire market is provided in development finance by non-banking sources.